Hello, my name is Elliot Yu. I'm the editor of Personal Finance as well as the Energy Strategist and co-editor of MLP Profits with Roger Conrad. Today I want to talk a little bit about the general outlook for the market and the economy, and then talk a little bit more about some specific sectors that I think are going to benefit from the current environment. Just looking at the U.S. economy as a whole, we are definitely seeing signs of a cyclical rebound. The recent third quarter GDP number was a better than expected, up 3.5%. As we've been saying for some time in personal finance, really since the beginning of spring, we felt the recession would come to an end over the summer months. I continue to believe that it has been the case. We probably saw the recession end in July. A lot of people are still focusing on unemployment statistics and employment statistics, but the reality is that those tend to continue rising. It continues to get worse for several months, several quarters in fact, after the recession actually comes to an end. What we are seeing is some signs of growth in certain sectors of the economy. A lot of what's going on in the third quarter number was really inventory situation. Inventories were liquidated at a record pace at the end of 2008, early 2009. A lot of that had to do with the credit crunch, which was the worst really since the 30s. Lately we've seen the pace of inventory liquidations begin to decline. And I think as we move into 2010, we'll probably see inventories start to rebuild a little bit in certain parts of the economy. That alone could add considerable points to the gross domestic product and create an uptick in things like industrial production, which we've begun to see just recently. We're also seeing that on the consumer side of things, the consumer remains fairly sluggish. But really expectations aren't that high for the upcoming Christmas season, so there's a good chance that certain pockets of the consumer spending will be a little bit better than was actually anticipated. So generally what we're seeing in the U.S. though is really a cyclical rebound, not a period of secular growth. What I mean by that is if you look back at the period from 1968 till 1982, we saw the U.S. economy see a number of cyclical moves. Pretty nasty recessions such as we saw in '74. And also some pretty dramatic recoveries, such as we saw coming out of that 1974 recession. The market actually behaved in much the same way. If we look at the stock market, the S&P in general from 1968 to 1982, it was basically flat. We saw some dramatic rallies of over 100%. We also saw some very, very nasty sell-offs. And I think we're in for a very similar situation this time around. Looking beyond that, though, where is the growth? A lot of the growth we're seeing in actual corporate earnings released over the last several weeks have been coming from outside the United States. The S&P as a whole is approaching about 50% of earnings coming from outside the United States and Canada. Some sectors are higher than that, technology and energy being two sectors that are heavily exposed to overseas growth. In fact, those are two sectors we've had overweighted in personal finance really since the beginning of 2009, and ones that we continue to think are going to do very well going forward. In places like China and India, we have more of a secular growth story. There you have less problems with debt that we have in the United States in terms of household debt. You also have very young economies that they could stand to grow very quickly over the next several years as they develop, and this is going to be generally a tailwind for stocks leveraged to those economies. And we're seeing it really across the board. Again, as I mentioned, tech and energy are two areas to really keep an eye on. Outside the United States, we've had some success investing also directly in those countries. For example, in personal finance, we have an Indian bank which has done very well since we recommended it in August. Really the story there is that the Indian consumer is pretty under-leveraged. They don't carry a lot of debt. And things like mortgages and auto loans are just becoming popular here over the last few years as consumers sort of reach that tipping point of income where they can start to afford and sustain higher levels of debt. That's really going to fuel consumer spending in those countries, just as it did in the United States 40 or 50 or 60 years ago. So moving on to some other sectors to keep an eye on. Obviously one area that's very, very popular right now is income, and that fits well with our MLP Profits newsletter, where we focus on the Master Limited Partnership Group. These companies have continued to do extraordinarily well this year, bouncing back nicely from last year's swoon. One thing to keep in mind, and one thing that I get a lot of questions about, is a number of the Master Limited Partners have come out and issued additional shares. In other words, they're coming out and offering additional units to the public, selling more stock basically. Typically, the immediate aftermath of that is that you'll see the MLP fall in price. In other words, if they come out and issue a few million shares and they have a float of 30 or 40 million shares, you can see that MLP come down 4 or 5% overnight. Generally speaking, this is an absolutely great buying opportunity for these stocks, and we're going to see a lot more of this over the next 6 months. So it's definitely coming to, something to keep an eye on. Most recently, TK LNG Partners, which is one that we hold in MLP Profits, came out with a secondary offering, and I think this represents an excellent buying opportunity for that. Basically, the reason they come out and do that is they're raising capital typically to fund future growth plans. In the case of TK, they're using it to repay some debt on a revolving credit line that they have. Most likely we'll see them come out and actually acquire some new LNG carrier ships, which is their core business, from their parent, TK Shipping, as we move into 2010. Ultimately, that's going to mean a lot higher distribution growth. In other words, a lot higher yield for investors. And so therefore, it's really a very positive thing. Every single one of the MLPs in MLP Profits that has come out with the secondary share issuance so far this year has seen an immediate drop in price, but is currently trading far higher than they were ahead of that share offering. In other words, historically speaking, over the last year or so, it's been a very, very good time to get into these stocks. That's something definitely to look for if you're looking more on the income side. So just to sort of summarize overall what I'm saying, cyclical recovery in the U.S. economy, more of a secular growth story overseas. What sectors to play from a growth angle? We like energy and technology. Both those sectors are heavily exposed to non-U.S. earnings, and both those sectors are actually been performing very, very well, and we would continue to overweight them. On the income side, we still think the MLPs are a great bet, despite the fact that they've run up a lot over the last several months. They're still trading at historically positive valuations. One thing to look for in terms of an opportunistic standpoint, little shorter term standpoint, whenever you see one of these recommended MLPs come out with a secondary issuing of shares and you get that immediate drop, that's a great time to pick up more units of that MLP. You're going to get a little higher yield by doing that, and you'll probably see some excellent capital gains as the MLP bounces back from that sort of knee-jerk sell-off of following those secondary offerings. Thank you very much.